We went from no growth at all to doubled our MRR. And we just started to take off like a rocket ship.
A lot of people think that if they want to make millions, they need to fundraise.
When you've bootstrapped a company, you have to be a really smart problem solver. Then as you start to scale up, you need to find people who are actually better than you.
Hey, awesome people. Welcome to Bootstrap Stories, the only podcast where founders of bootstrap companies share in all transparency the ups and downs of their journey. Starting a business comes hand in hand with loneliness, the pressure of not being successful, and overall, lots of challenges. After meeting with hundreds of entrepreneurs in the past years, I figured out that we all have struggles and make lots of mistakes when building a business. But the truth is that most people are afraid to share this publicly. That's what motivated me to start this podcast, to show that we're all on the same journey, facing the same struggles, and to give energy to all entrepreneurs worldwide to continue their adventure. Even if sometimes it can be really challenging and we often feel like giving up, in the end, it's all worth it. My guest for this episode is Racki, co-founder and CEO of Proposify. Hey Kyle, and welcome to Bootstrap Stories.
Hello Guillaume, thanks for having me.
I'm super happy to have you here. I know we're going to talk about a lot of interesting topic. And before we get started, I also want to give a general idea of what we'll talk about in this episode. So first, we'll find out about the strategy that helped you to build your multi-million-dollar business, being bootstrapped first and then switching to raising money. We'll also have a chat about, this switch. How exactly did it go? What type of deals have you done? Why did you decide to fundraise? And finally, I also want to know the ups and downs because, whenever we're building a business, we all have these ups and also these downs. So it's always important to share between founders. Sounds cool?
Sounds good. Let's dig in.
Awesome. So can you let us know a bit more about Proposify, how it started? What type of market are you addressing?
Yeah, I mean, the way it started was I got my career beginnings in design. That's what I went to school to study back in around the early 2000s and kind of cut my teeth working in agencies as a designer. And it was during that time where they had me laying out proposals, any of sort of the larger ones that the agency was going after. They would have me lay it out, make it look really nice. And I noticed that there was a lot of inefficiencies in the process between, account managers emailing Word documents and then having to change the text in layout and having to go find old case studies from CDs. That's before we had Dropbox. We would used to store all of our project work on disks. And so, Basecamp, I think, was pretty new at the time. People were starting to use it for project management. And I just had an idea of, wouldn't it be cool if there was a proposal system that was like Basecamp, but for proposal writing? And it was just the seed of an idea that I never really thought would take me to where I am today, because it was just that, an idea. A lot of people at the time were having hey, there should be an app for that. But over the course of working in agencies, and eventually I went out on my own and became a freelance web designer, developer, partnered with a colleague, and we started our own agency together. We just kept going back to the idea of we should have a SaaS product. That's a better business model. We didn't like the agency model. And so we tried a whole bunch of different ideas, and I still had that proposal idea lingering in the back of my mind. So when I started to talk to other people about it and said, hey, we're looking at building a product to help with proposals, people almost universally would say to me, that's a huge problem. I hate writing proposals. It's the worst part of my day, but we have to do it to win new business. And that really kind of gave me the green go ahead of this is a problem worth solving. We need to do it. So that's kind of how it started. And essentially what it is it's a SaaS product that helps sales teams get more control over their proposal writing, streamline it, make it more efficient, but also get more visibility into their deal. So instead of just sending a PDF in an email, you get to send it to your client in a digital interactive format where you can actually track where people looked and where they went, so you can improve your close rate over time.
It's actually a cool product. When I had my agency back in the days, I remember using it, and I was kind of picky on the design type of aspect, and I remember enjoying using it. So going back to the early days, how exactly did you get your first customers, and maybe can you give us a bit of metric of when exactly did you start it? Where are you at right now in terms of revenue and team size? And then go back to like how it started with early days and customers.
So it was a very long process to get off the ground, because we were talking about it and thinking about it, and I was kind of mocking up what it could look like as early as maybe 2011, while we were still running the agency. But we were kind of faced with the same problem that a lot of agencies have, which is a lot of them want to build their own products, but to take your dev resources off of paying client work to invest in a product takes a long time. And often it just doesn't get the attention it deserves. Paying clients come first, and eventually they kind of abandon it and just go back to what makes them money. So I kind of knew that was a problem from everything that I read and had experienced before. So we actually took a different approach, which was I went to basically look for a dedicated engineer to build the product. And I looked for one who had the skill set that essentially I needed, which was I wanted something that would enable great design. And as a designer and with that background, like we had to be able to move things around in layout and change typography. And we had to do more than just essentially like a WYSIWYG editor, which a lot of the only existing solution at the time was essentially a typical WYSIWYG. So I found this JavaScript developer, and we were lucky enough to have, where I live in Canada, especially where in Canada I live, there's this thing called the Atlantic Canada Opportunities Agency, which is essentially it's a facility to get interest-free loans, grants. It's all government backed. So they were trying to build up the tech sector where I live. And there was something where they would essentially fund half of the salary of a full-time engineer. So nice. we got approval on that, hired Jonathan, funded half of his salary, and the rest was covered through a grant. And so that was how we essentially got him in the agency. And I said, like, you're working on this project. I don't care who comes to you. You're not working on it. You're fired if you work on client work. Like, you have to just work on this. So it was really me and Jonathan for the better part of a year, just going back and forth. I would sort of talk to customers or potential users, figure out where things were broken, where they were getting confused, design the screens, and then bring it to him, and he would build them. And we worked really well together. Finally, when we started really getting it off the ground, would have been around 2013. And then a year later in 2014, we sold the agency, went full-time into Proposify. And that was still really with only about maybe 10 users or so. It wasn't significant traction.
Okay, so after selling the agency, it was in 2014, and this is when basically you decided to go all in on Proposify. So at that time, you had like enough money from selling the agency to sustain like for how long would you say, like a year, 2 years? What was your kind of roadmap back then?
Well, it wasn't quite that simple. So we didn't actually make money from selling the agency. Maybe if viewers could see me, they would see air quotes of selling. Essentially, the agency was underwater. We were, it wasn't profitable, and we were just trying to essentially offload it. So we did find somebody who would take it over, but they were covering like the debt and the payroll and the client list. They weren't really paying us anything for it. But it was a chance for us to get a clean break and start fresh. So we actually raised a very small round of funding from the local government agency to get going. It was about $250,000. So you might be able to say, well, we're not technically bootstrapped because we did raise early on, but it was a pretty small round, and the $250K didn't go far. So it was enough to maybe cover me, my co-founder, and the engineer for 10 months or something like that before we ran out of money, just to keep the lights on. So I still like to think that we were bootstrapped.
Yeah, I do feel. I mean, it's more of a kind of like a grant or like subsidiaries from government. So I think we can still say it's bootstrap. And after those 10 months, what was like kind of was it the deadline where you say, okay, if we don't make enough money to sustain ourselves, it's over? Or what was kind of like the approach?
I mean, that was pretty much it. When we went out in, I'd say by the time the check cleared and we were completely free of the agency, it was about May of 2014.
Okay.
We had under $1,000 in MRR, so not enough to sustain ourselves by any means, and it wasn't growing either. Like we would get a new customer maybe to sign up, and then lose another one the same month. So we were very flat. But it really came down to product market fit. And I think, anybody who's been a bootstrap founder knows that journey to finding, are we building something ultimately people want or the market wants? We didn't have product market fit. So we kind of knew that, okay, there's a few key product gaps that need to get closed in order for us to satisfy customers, because like I was able to drive traffic to top of funnel. Like I was pretty good at marketing because we ran the marketing and web design agency. So I knew how to blog and content, create content and SEO and everything just to get people to the front door. They would say, "Oh, this looks great. I want it." Sign up to it, and then be like, "Oh, this kind of sucks." And then they not buy. So, okay, how do we make it not suck? So we found out that number one, like the biggest barrier to entry was getting your proposal content in the system, right? Because you couldn't just upload a PDF like you would say DocuSign. You had to actually be able to interact and edit these things. So the way we solved that problem was, let's just create like 10 amazing looking killer templates that you can customize. So as soon as you sign up, you could go, "Oh, I'm a web design company. There's a web design template. It looks awesome. I've got 3 choices. I'm going to pick this one." And now I can start, putting my own pricing and my own content in there. That with 2 features that really I never thought people would want. In hindsight now, looking back, people would say, "You're crazy. How did you not think that people would want these features?" But they have to understand these weren't common. This wasn't the status quo at the time. These weren't common features. Was e-signatures. So common now. Every product pretty much has its own built-in e-signature capability. Back when I was running the agency, we didn't use e-signature, so I didn't think anybody would want it. We'd fax, and email contracts back and forth. The other one was metrics. Like people said, "Oh, I want to know, like, did they spend time on the pricing section? Did they even look at the scope of services?" And so when we had kind of those features with the ability to get your content in the system easily, it was pretty crazy, because we went from like no growth at all to, in September, we doubled our MRR, and then we doubled it again the next month, and we doubled the next month, and then we just started to take off like a rocket ship. So it was a pretty exciting time.
Nice. So basically, like from May until September was the time where you kind of like refined the roadmap, developed the right feature towards product market fit. And once you had this product market fit, you were growing like 50% month over month. And was basically like the growth just exponential, or did you hit? Because right now I think you're around like 12 to 15 million in annual recurring revenue, or?
Well, yeah. So at the time we went from ending the year at 40K in ARR,
okay,
$4,000 MRR roughly,
okay,
to 600K ARR by the end of the next year.
Wow, nice.
That was about 1,300% growth.
Okay, yeah, that's really, really intense. And how exactly like did you hit any plateau like from that day to right now, or was it just exponential and you keep facing exponential growth?
Well, I wish that was the case, but no. I mean, we had a pretty incredible couple of years of growth, because we grew 1,300% that first year, about 130. So we more than doubled the next year. But so by the end of 2016, we were at like 1.5 million in ARR.
Nice.
And then we had another double year the next year, which was we hit 3 million the following year. But we definitely have had our growth challenges in that time. And that's where we got into like raising money, hiring a sales team, and trying to kind of do all the things that SaaS companies typically do when they're looking to scale up.
Okay. So I'm quite interested in understanding. So let's say like you were having hyper growth, then you started to see kind of like a decline in growth. And at that time you thought, okay, maybe we need more resources to scale. This is when we're going to raise funds. How exactly did the fundraising go? Because what people mostly do is like, okay, when you're hyper growing, it's quite easy to have like kind of the best terms whenever you want to fundraise. But in your case, you went to see like VCs or investors with potentially like a growth which was declining a bit. Like, did it affect the fundraising, or how exactly did the investors react it?
We actually started to raise before our growth was declining.
Okay, that's smart.
Yeah, the fundraising was pretty good. There were some leading indicators though that that we needed to fix some things. And one of them was our churn was quite high.
Okay.
I don't remember exactly where we were at, but it was sort of above where you would want it to be, like above it was let's just say 3-4% monthly churn.
Okay, because you are targeting like SMBs, correct?
Yeah, we were targeting very small companies when we started. And then throughout that time of hypergrowth, we started to experiment with a slightly larger pricing model. I wouldn't call it enterprise. It was more, a few $1,000s a year kind of slightly bigger team, but not even mid-market. But to do that, we hired a couple sales reps, really no process, no manager, just like, hey, let's throw a couple salespeople at this because we got tons of traffic coming in all the time. We have tons of signups, thousands of signups every week. Let's see if we can get some sales reps to like try to identify some good potential, maybe do some outbound prospecting to find bigger ones and see what they can close. It wasn't like super successful, but we did start to note that whenever a sales rep would close an account that was like $3,000 a year, which we thought was really big at the time, we were like, wow, well, why would someone pay us that much money? Of course, like now we've got accounts that are, $150K or $100K a year, but at the time, 3,000 seemed like a lot of money to us. We did notice that the churn was always like zero. It was like in the negatives. We would keep those bigger accounts on. We would have somebody kind of service them and help them onboard and really but once they got embedded into a company's workflow, they'd never leave. And so that was the narrative that we would then take when we went to raise money from VCs is that, hey, we've got this great organic business of self-serve and trials that works. The churn is quite high though, but these are very small customers. And it's really hard to do anything about churn when you can't control why they're canceling. So if people are canceling because like your product is crappy, well, make a better product. But if they're canceling because like, oh, I only have sporadic use of this, like I only use it a couple times a year, then we're going after the wrong customer. We need to find a customer who has this problem all the time and needs this problem solved perpetually. So that was sort of when we started to go, maybe we should move up market. Our main competitor, Pandadoc, was starting to do the same. So that was kind of the narrative we took to go raise money.
And basically, like, what were the terms of the fundraise? Like, how much money, and also, like, why did you choose to switch from Bootstrap to fundraise?
Yeah, I'd say like my co-founder and I, Kevin, had always we'd known people who started startups and raised money. A lot of them raised too soon, and a lot of times they went out of business very soon afterwards. We'd heard all those horror stories where like investors come in and then if you don't hit certain targets, they try to like down round you or kick you off out of the company. And that always spooked us. We didn't want that. And in fact, we had an opportunity about a year prior, maybe a year and a half prior to raise VC money that we turned down. So when we were just starting to take off and hit that, that early growth, VCs gave us a term sheet for, I think it was 1.5 million or 2 million or something like that on a pretty fair, like I think a $5 or a $10 million valuation. And we said no, because we said, you know what we're doing today is we're profitable. And every time we get really profitable, we just take some of that profit and reinvest it in like a hire. So maybe we need a support person, maybe we need another designer, but we wait. I always likened it to like bulking and cutting, like that bodybuilders do, is like, if you get a little too fat, okay, you need to cut down. And then maybe you get too skinny, so you need to bulk up. And you go through those rounds, which I think is really healthy for a business, especially a bootstrap business, of like get yourself profitable, but then start to like funnel some of that back and reinvest it back into the business. But then when a big change, I think it came down to Kevin and I looked at it and said, our ultimate goal with this company was to scale and exit. But what if we could sort of get a little bit of that exit today and still scale it long term? And at that time, we were reading things about founders who had taken secondary. And that was enough to, I think, for us, balance the risk of like, okay, we could raise money and like lose the business and suffer some negative consequences. But on the plus side, if we raise money, we could take money off the table, which would give us a nice injection of cash. So we wouldn't necessarily need to be like desperate to sell it too quickly. But then it would also infuse capital into the business that we could use to grow even faster. So that was kind of our rationale for raising.
Okay, so just for our listeners, secondary means basically that you are taking cash off the table, meaning like the founders are getting a bit of money. Most of the VCs or traditional investors usually are not so fan of doing secondary. I think now it's changing a lot, and some investors are actually leveraging it as a competitive advantage, which I think is really great for founders. Because it's, and I think you mentioned it very well, it kind of like de-risk the business, meaning that you as a founder, you are both taking like money out of the table, which means that you can keep building the business for the longer term without thinking too much about this risk of losing everything. So what were kind of like the terms, like how much did you raise and how much were secondary, if you're willing to share?
Yeah. So when we raised from these investors, they were willing to give us $10 million across 2 different tranches. So the idea was they were going to split it into 5 million the first tranche and 5 million the second. And out of that, Kevin and I were going to take 2. So one
each. Okay.
3 million back onto the balance sheet. And then if we hit our targets within that year, which we were pretty aggressive, it was scaling to like 10 million in 1 year. Then they would come in for the second tranche, and then we would get the rest of the money. So that was how the deal was set up. And it was actually a really great deal for us in terms of like the valuation. Was the multiples were strong. It was a fair offer. We thought, $1 million at the time, like not even at the time, even today, is like it's life-changing amount of money, when you want to pay off your house and reinvest it and all that kind of stuff. So it was an amazing offer. I think we just picked the wrong investors, and that was part of the problem, because this was sort of like, I think they knew that we weren't going to hit the target, so that they essentially were able to like still give us the money the next year, but at a much lower valuation. That was kind of, I think, the game they were playing. So unfortunately, it did turn out the way that the nightmare that everybody worries about with investors is, they're going to down round you and take your company and all that stuff. That actually did more or less happen.
Oh, fuck. Can you share like a bit the details of how it happened?
I've got to be careful because I doubt they're listening, but they're pretty litigious people. So
okay,
I got to be a little bit careful. But basically, it was a very distracting situation where they still wanted to come in, but they wanted to essentially own them,
lower the valuation, and okay,
yeah, like significantly. And I think they had done it before, but I'm not entirely sure. But either way, Kevin and I just put our foot down and said no. Like if you're going to try to down round us, we just won't take the second offer or launch. And
just to yeah, I can imagine. And at the time, because what's a risk, whenever you're like fundraising, is that eventually, like, because you injected money in the company and you had like kind of your hiring plan, etc., you are burning more money that you are earning, meaning that, like down the line, that if you're not raising another round, eventually you would have to lay off people, or like, was it something that happened to you back then, or were you quite like, had you reached like the profitability state again, so you are in a good position?
Yeah, I'll lay this out for the listeners, especially if they're not too familiar with venture deals and terms and this kind of stuff. Is that like, let's say your business is doing 5 million in ARR. Typically they would get valued at 5 to 10, or at least back then it was like 5 to 10x that. So that means like if you're a 5 million ARR or a SaaS company, you can probably command a 30 to a $50 million valuation. The idea is that like investors are valuing it at that because they know that if you reinvest that money into growth, then you can actually be worth 10 times that amount in a very short time. So they're kind of willing to give you that healthy valuation. But if you don't hit that growth target that they had set out, like you said, you're burning more cash because you're reinvesting it into hiring people. You're not profitable because you're essentially burning through that investment. You're essentially hiring ahead of the revenue. So it's very important to understand that, like, and I think this was one of the learnings that we had taken away was, when you set aggressive growth targets, you think it'll sort of push and inspire everybody to level up and hit those targets, but it can also have pretty significant consequences. Like you said, like we laid off most of our sales team
Okay.
about a year after that because we'd hired, but we didn't have a really great process. There was a lot we didn't figure out: pricing, positioning. We didn't have the right product to move up into the enterprise. So it meant like we hired lots of great salespeople who just couldn't be effective and they couldn't hit targets. And unfortunately, we had to let them go.
So when you're at that stage where okay, like they want to kind of like down round, take more share in the company and keep injecting money, and you and your co-founders, you say no. What comes next? Because they are obviously like very frustrated. You on your hand, it's like kind of a shitty situation to be in when you're a founder. If you have to like fire people you've hired, you've put a lot of energy into the business, into the processes. Like, what's comes next? Basically, like it's
hell. I mean, it was one of the most challenging situations that we've experienced in the business. We had a really good, outside of those investors, we had a really good board member who was in our corner. We had good lawyers and good finance people who were able to really give us the ammunition we needed to push back. But I mean, it really got into those classic, almost something you would see on TV where like it comes down to a vote and, 3 against 2 at the board level. And then they're pushing back as shareholders and all that kind of stuff. So it was a very, very difficult situation, but we held our ground. We were not taking more money from these people. And ultimately, we were almost forced to raise again because we had to find new investors who saw the potential in what we were doing and were willing to not only come in and give us capital, but also had enough cash to buy out the old investors and take them.
Okay.
And that's what the investors the first round of investors that we had the issues with, ultimately just, if we weren't going to take their money, then just find somebody to buy us out because we don't want to, we're going to take our ball and go home kind of thing.
And in the second round you did, how much was the second round? And did you take another cash out of this round, or was it just, okay, like the second round is for buying existing investors out and potentially injecting a bit more money in the company?
Yeah, so I can say who our current investors are. We've been public with that, which is CBGF, the Canadian Business Growth Fund. Okay. And I don't think they want me to give out all the exact details in terms of sure. the arrangement, but essentially we were able to raise enough to put money, millions of dollars on the balance sheet, buy off the old investors, and they did it during COVID. Like we had a deal all lined up, ready to go, and then COVID happened, and every investor was putting pause on their deals. We were extremely lucky that they, even after 2 weeks of essentially the world shutting down, they came back to us and said, you know what, we're not going to go ahead with every deal that's in our pipeline, but we believe in you and we're going to invest. And it really saved our ass because the old investors were being quite aggressive.
Dicks.
Yeah.
Actually, like I think for every people listening, if you're thinking about like raising money, something, and I think you would agree on that, Kyle, is do due diligence with the funds who are investing in your business. So try to reach out to people who they have invested in, but went out of business, people who they have invested in, but where the company was flat just after the investment, just so you understand how the investor would react when shit hit the fan. And that, because, I think in your case, it's, as you said, like, you basically told me that they might have done this to another company. Usually these things like travel fast, and it's quite easy to get the word, and it will not prevent every issue, but it might for some just prevent for getting someone you don't want to do business with. So I'm glad you actually found new partners whom you are actually getting on well. And since then, everything is cool with them, or were there any other ups and downs with the new partner?
Well, I mean, there's always going to be ups and downs in a business, especially when you're trying to grow aggressively. But as far as the partnership with CBGF and having them as board members, they've been nothing but kind and supportive.
Nice. And looking back at this kind of story of being bootstrapped, owning your business, being able to do everything you want, and then moving towards like first round of fundraising, going kind of like through hell, as you mentioned, and then having like a new partner. Is there anything that you would do differently?
That's a really interesting question. And it's one I honestly kind of grapple with, but it's a fun topic because I think it depends like how meaningful. So there's a couple frameworks, I guess, to think through this, which is number one, like how important is getting cash today? Because if you're like me, like I did not come from wealth. I was a struggling entrepreneur for years. I went through periods when I was running the agency where I could barely, sometimes I couldn't afford to pay myself or pay rent, and I had a family, kids, and all that stuff. So I was used to being poor. So the prospect of getting like $1 million in your account was a little bit too much to turn down when that's kind of the world you're coming from. But at the same time, I think it was a bit short-sighted because it did end up putting us in a deal with the wrong investors. So we were kind of lured, I think, by the cash, but ultimately it wasn't a good decision. But I think if you can stick it out as a bootstrapped company, if you're profitable and you're growing and you can get the business to like, past the $2, $3, $4 million mark, and that your margins are healthy, I mean, you can have a very profitable, like I know SaaS founders with 10, 15 million ARR businesses bootstrapped that pull like $4 million out a year personally. And I think most people would agree, like that is probably a better way to run a business than taking outside money in and then basically having a lot more pressure to burn, to hire, and to hit more aggressive targets. The flip side of that is if you look at people like David Cancel behind Drift and these sort of like serial entrepreneurs and all of their businesses are venture backed, they're trying to build $1 billion public companies. And if you want to do that, there's not really too many options at your disposal other than raise venture capital. So it really depends what you want out of life. A lot of times if an entrepreneur has had a couple of wins under their belt and they're good and they've got enough cash personally, a lot of times for them, it's about the excitement of like climbing Mount Everest. So for them, they're like, I'm going to spend somebody else's money to build like $1 billion company that's going to outlive me. That's exciting for them.
Yeah, I think it's really based on your purpose, because I do feel like in the media in general, we always focus, on this huge fundraising and we make it kind of like the norm. But as you said, like I love bootstrap companies with, where the founders are taking dividends each year, making like a lot of, because I do feel that a lot of people think that if they want to make millions, they need to fundraise. Like it's the only path. Whereas actually you have like so many other options. And as you mentioned, being profitable, being able to have like a healthy business with large margin, which to be honest is fairly common in SaaS businesses, is also definitely like a great route.
You can also sell it if it's bootstrapped. If you want to cash out and make your $100 million dollars from the acquisition, you can still do that if you're bootstrapped and you get to keep it all. So there's a lot of really good things. Though the other factor, and I know you probably want to move on, but there's the other thing to consider too, is that a business does not have an indefinite amount of time to win its market. So competition is a real thing when you're bootstrapped. It's a real thing all the time, but it's especially real. Like if you're the first to market and you're like number one in your category, as soon as another business comes in and raises, it becomes increasingly hard to stand out compared to that competitor. And I've got my own, example, who I don't want to mention my competitor again, but Basecamp is a good example. They're like almost the godfather of bootstrapped SaaS businesses. But if you look at project management software nowadays, Basecamp usually doesn't come to mind for most people. It's Asana. And Asana is the well-funded, venture-backed competitor that's like crushing Basecamp. Now they'll say they don't care, they're profitable, they don't care about growth. That's fine. But competition is a real factor when you're up against venture-backed startups.
Yeah, I agree. I think in the end, it's all about like market attention, market shares. But yeah, I think it's true that most businesses often we think that they have like infinite lifetime, but they don't really. And something you mentioned about like selling your business, etc., especially in the SaaS space, I've seen more and more like interesting companies like Microacquire, for example, who basically like facilitates, like all this selling process. You have also like tons of brokers that can help you out like with selling your business. That's what we did actually with one of our SaaS projects that we built. We wanted to focus on Lemlist rather than focusing on other things. So we sold it about like a year and a half ago. And again, as you said, like it's also an easy way like to build a project, sell it, maybe focus on something else or run other businesses. Closing on that part, I'm quite intrigued, like because we mentioned about this transition going from Bootstrap to fundraising, having the ups and downs. Were there any other like because I think it's quite interesting because you're like being fully transparent. So I want to dig in that also. You're targeting SMBs. You have like this kind of like churn issue, etc. Like when you hit a plateau, what's kind of like your mindset behind it? Like how exactly do you address it? How do you address it with the team? What's kind of like the step-by-step process?
Well, there's my opinion now, and there's what I did at the time, and I think my thinking has evolved on this. And I think even if I give this advice, most people listening will still ignore it and then suffer the consequences and then be like, oh shit, I should have listened to Kyle.
Listen to Kyle, guys.
This is the painful truth, and it takes a long time to get this. When you've bootstrapped a company, you have to be a certain kind of person who's like really good at a lot of stuff, really smart, problem solver, can do marketing, can do some product, can do some sales. But then as you start to scale up, you need to find people, not just like people to take tasks off your plate, but people who are actually better than you. Most, I would say in this, I don't have data behind this, but I'm going to say most entrepreneurs do a really bad job at this. They instead try to find like, well, I'm going to find somebody who can do this almost as good as me just to like take all the monkey work off my back. Instead of like, I'm going to find somebody who's like built a $10 million business and marketing or product, and I'm going to hire them, pay them whatever they want to take this to the next level. So the faster the more you grow, the bigger you get, you as the CEO, your job completely changes. You're no longer just like the scrappy person who just needs to figure it out. You've really got only a couple of jobs. You need to set the vision and the direction of where the company needs to go. You need to hire the best executive team money can buy, and you need to not run out of money. So you need to manage your burn rate and your growth. And really, if you can do those three jobs well, you'll have a scaling, profitable business. But what most people won't do is they won't let the initial people who help them get to where they are, they won't let them go. They're like, the person that was in the trenches with me helping to get the product market fit, I want this person to be still on my team, past 5 million, 10 million ARR, when really you should probably let that person go and go hire the best VP of product, VP of marketing, VP of sales, whatever happens to be, to take you to the next level. And most won't do that. Or if they do it way too late and they take too long.
And what has been like kind of your strategy to find these people and convince them to join you? And how do you find them also?
Finding people's not that hard. It's being willing to tell the person who helped you build this great business, you were a good fit a year ago, you're not a good fit anymore, you should go find another company. That's the hard part. It's the part most founders aren't willing to do until it actually hurts them and they have to. Right? And because finding somebody's like, okay, you go through job ads, you recruit, you headhunt, you find somebody awesome, you interview them, you pay them enough, stock options or enough salary or enough of a bonus structure to incentivize them. That part's not that hard. It's telling the person that you're replacing them with, like, you've got to go.
And what have you done to make this process like smooth when you know that it's actually gonna be like really painful? Because obviously, like your first employees are the one. They're not co-founders, but you have more or less the same feeling if they were with you like from the early days. So how exactly did you handle it?
Well, I don't think I did it well, which is why I'm sharing the lesson. I think the way you should handle it is I think you should give people a shot, but you should be very clear about, like, if you're leading, and I'm just using random examples. Let's say you're leading engineering today. Here's what the job looks like a year from now, which means it's actually a different job. Your title might still be head of engineering or VP engineering or CTO, but what got us to here is not going to be what takes us to the next level. That's a whole different job, and you need to re-qualify for it. I never said that to my people, right? But the way it is now is like, yeah, if the person who gets you to 1 million probably can't take you to 10, and the person who gets you to 10 can't take you to 100. So it means that you have to like keep the standard high, make them accountable for hitting the number or hitting their commitments or their goals. And then if they show that they just can't level up fast enough, and knowing that 80-90% of people won't, it's being able to say, you know what, I want to celebrate what you've accomplished. You've been amazing. You just can't get us to the next level. And I think you should go find a new opportunity to do what you just did for us, but do it again for somebody else. That's how I handle it now.
And do you feel like the best option is actually to have them find another opportunity, or potentially like have them stay in the team but at a different position? Like, how do you like perceive this, and is this something you've tested?
I have tested it. I've had those conversations with people who were leading a department and said, you're not going to be the one to lead it moving forward. I need to find somebody who can, but you can stay in the company and we'll find some other job for you because you're still really good at whatever it happens to be, coding, marketing. I don't think it's ultimately that successful in the long run. Because even though a lot of times people are like, oh, I love the company, I'll stay on, it's fine, I don't have an ego, I don't need to run the department, I just like to work here. What you often kind of find is that there's usually some level of friction between them and their new boss, because they're like, hey, I built this thing, and now you're the corporate VP coming in to tell me how to do my job. You also tend to almost create too many roles in the company. This is a really big problem that happens, is that as you grow, especially if you've got some cash to use, from investors, it can be very easy to get away from that sort of lean startup idea where you're just like, oh, let's only hire A players. Let's only hire like people we absolutely need today. People get very generous with who they're hiring. They're like, oh, well, my plate's pretty full, so I think I'm going to hire a junior person to like help take some things off my plate. And then you end up with this kind of bloated organization where there's a lot of people, but nobody really knows what they're accountable for. And this can happen anyway. I don't mean to ramble, but this can happen when you sort of take the people who are leading and say, well, you're not good to lead the whole thing, but we'll put you somewhere where you can be effective. You often find that they're not able to operate at the level that they could before when you were an early stage company. So it usually is better that they just move on and find a similar opportunity and help a company like you, again, just do what you did again somewhere else. There's a lot of people who they're awesome at that.
And I'm curious because I think this is like a very like passionate subject for us, because like we grew from 0 to 10 million ARR being like fully bootstrapped, and we're at a stage like having all these questions like how do we go from 10 to 100, knowing that all the heads of that we have right now are people who started the company. I just like want to mention that I'm not gonna fire them after this podcast, but I'm just curious. Like, but it's funny because like the question, like you're asking people and how the role is evolving is something that I'm doing like constantly. Where every like quarter or year, I'm telling people where they're at right now and where they should be or where I need them to be in the next quarter, and we reevaluate basically like. On a quarterly or semi-yearly basis, I would say, like the role of everyone. But you were mentioning that the role of the CEO evolved over time. And as you said, like it was your role as you're growing past, let's say 5 or 10 million ARR. It's really about defining like the vision, the mission, and also making sure that you don't run out of money. But how exactly, like two questions for you. The first one is, how many people do you manage directly? Or how many people do report to you directly? And on top of it, like, how exactly do you set up each objective for each department? Is it you handling this for each department, or do you just set the vision, set the yearly objectives, and then people will report to you, come to see you and tell you, okay, here's a plan, here's how we're going to reach that. Are you cool with it? Let's go.
So there's the first question is quite easy, because if you're a CEO, generally there's about 6 functions of a SaaS business that somebody needs to own and somebody needs to report to the CEO on. And that's product, engineering, sales, customer success, marketing, and operations. And we'll say operations is a catch-all for finance, legal, as well as more like the actual operations of the business. I do a little bit of part-time coaching for SaaS founders, and I find that at the sort of 2 million ARR mark, a lot of them have had success getting to where they're at, with the CEO kind of wearing most of those hats. If you say who actually leads product, they'll say, I guess I do. Like, there's somebody who like does the design work and maybe codes, but like I'm telling them what to build. So I guess I run product. It's like one of the starting points is like, we need to build an executive leadership team, and that executive team needs to report to the CEO. So when you go, why does our product suck? You need to go to the head of product and engineering and say, our product shit, make it better. Once you have that in place, then you need really good systems for setting goals and measuring them. And there's all kinds of different frameworks you can use. When we started, we used the EOS model, which is the entrepreneurial operating system. There's a book called Traction by Gino Wickman that spells out that whole system. And it involves, annual planning, quarterly offsites with the leadership team, weekly scorecard. Those are just good practices to put into your business, having some kind of weekly measurable, having some goals that you kind of set out with the team. But as you start to scale, that stuff becomes really difficult, because if you have a department that's made up of multiple teams, let's say 10 teams within a department, sometimes cross-functional. So you might have a team that everybody in that team reports to someone else. QA reports to the QA lead, engineering reports to the engineering lead, and so forth. It becomes really difficult for the executive team to even set goals for all those teams, because honestly, they shouldn't know what the thing is that they need to do. So what we started to implement, which is how I think a lot of companies like Google get around this, is OKRs. And the OKR system is really good because it lets you as an executive team say, at a high level, these are the objectives we want to achieve next year. Here's how we're going to measure whether or not they're true. And then once you set those OKRs, you communicate them to your teams, and then the teams go and they set their quarterly OKRs and say like, okay, so the company wants to scale revenue or reduce our churn or whatever the objective happens to be. Here's how our team is going to action that and move that ahead. And so they create their own set of more specific objectives and key results that will make the company move further ahead. So OKRs are a really good system for that.
Could you give like an example, for example, of what you said to, let's say, your head of marketing as the CEO?
Sure. So I will say OKRs are best used by product and engineering teams. That's my personal belief. I'm sure somebody would argue with me on that, but I think the reason they're great for product and engineering is it's really hard to give your engineering leader a revenue target. If you say generate 2 million in new business, pretty tough. Like, an engineering leader is probably not going to know how to do that, because they also have to make sure that like the system is scalable and stable and secure. And there's a whole bunch of engineering stuff that the leader needs to do. But if you can say like, we want to have a world-class product, we need to be the best in this market, or we want to, increase the collaboration that our system is capable. Whatever it happens to be, you can have something that's a little bit more qualitative to give to your product and engineering leaders. And so OKRs are really good for that, because they say, this is the outcome we want to achieve. Here's how we're going to measure it. Revenue targets are a little different. And I found in practice that every department can use OKRs, but for sales teams, for instance, it's generally better you just give them a revenue target. And marketing, same thing. Now, marketing will sometimes use OKRs to basically prioritize key metrics. Like, they might say, you know what, we're getting tons of leads at the top of the funnel, but our conversion is shit. So we're going to create an OKR that says like increase our conversion, and we're going to measure that, you know, the following ways. So that's one example of how the marketing team could implement OKRs. But at the end of the day, what you want from your marketing team is revenue.
Yeah. So as a CEO, basically, like your objective for the marketing team would be something like, we need to hit, let's say, 5 million more in ARR by the end of the first quarter or something like that. And then they would set up their key results, for example, like increasing website visitors by 200% or something like that. Is that correct? Or
yeah, like I think KPIs or key performance indicators are different than OKRs. OKRs are generally meant to be used in more of a shorter time scale. So you might set quarterly or even an annual OKR. KPIs are kind of like your business as usual metrics.
Okay.
So it's kind of like, I liken it to, you know, if you're driving to, if you need to make a road trip, you need to make sure you've got enough gas in the tank to make it all the way to the trip. Gas is probably a KPI. It's like something you need to know, and it needs to inform you along the way. But your whole purpose of being is not to have gas in your tank. It's actually to get to point B. That's how I like to think of it.
Yeah, it's a good image. So right now, if I understand correctly, you have like 6 people reporting like under you, and is it something that that basically like where you do like weekly one-on-one with them, or how exactly do you structure your weekly like reporting and day-to-day?
Yeah, so with the exec team, it's a weekly sync. We meet every Monday morning to review kind of those KPIs, the OKRs, bring up any problems happening that we need to solve as a team. And
so you do that with all your exec and you, is that correct?
That's right, yeah.
Oh, okay.
We do that with the exec team weekly. Quarterly, there's bigger planning sessions. We usually do 2 days of quarterly planning, and then like an annual one as well. I do weekly. I actually do every 2 weeks, hour-long one-on-ones, but I'm moving it actually to half an hour weekly just to get more touch points with the leaders. One-on-one should be non-negotiable in every company, I believe. I believe like if you're a boss and you're not having regular one-on-ones with your direct reports, then you're failing them as a leader.
Yeah, agree on that. I want to be like cautious of your time, like tons of really interesting topic that we went through. I want to finish with the last 3 questions. Who's your favorite Bootstrap founder, and also why? I know you mentioned Basecamp, so maybe you're gonna go with Jason.
I'm not gonna pick them. They get picked too much.
Yeah.
Better. Well, there's a few I know personally who I consider friends. One of them is Emmerich.
From Agorapples, or
yeah.
Nice. Yeah, I had lunch with him actually like last week because we were both in Paris. Really cool guy.
I didn't even pick up on that French connection. Yeah, well, so we're actually in the same coaching group. We're
nice.
Martel's coaching group. So that's how we met. And I love Emmerich, and I love the way he thinks. He actually taught me about OKRs. He like sent me his own internal video that he made. So I love Emmerich. I'm gonna pick him.
Nice. It's a good choice. I second that, and we will have him on the show also a bit later. It's planned. Second question: what's your favorite like podcast or book?
I don't listen to podcasts a whole lot, and I read it, but I do read a ton of books, and so it's really hard to pick one. One that I read, the one I'm reading currently is actually Netflix's No Rules, which is a really good one. One that's kind of like a classic one that everybody references that I only read last year was Crossing the Chasm. And it's a great book, especially if you've had that kind of early bootstrap success, but now you're looking at like, how do I take it to the next level? Crossing the Chasm is a great book.
Nice. Actually, it's funny you mentioned it because I had like someone on LinkedIn mentioning it like to me today about like, this is really a book you should read. And I guess I'm gonna have to go and buy it on Amazon.
The problem with books is most people don't read them until they're already experiencing the problem. Like there's kinds of books people told me to read, and I was like, yeah, I don't care. But once I'm like feeling the pain, then I go and read the book.
Yeah, I think that's the best way to read a book. To be honest, it's the same as when I was younger, I used to be reading books, like the traditional way. You start from page 1 and you end up until the end. But right now, I usually like skim through the book once, and then I just pick the chapters when I know where I'm facing the problem, because I guess this is the time where you can actually plan and apply all the learnings directly to your business. And that's, to me, like the best way to learn something and like make sure you own the topic in a better way.
A really good example of that one is The Hard Thing About Hard Things by Ben.
Oh, yeah.
It's one of those ones, like, I don't know if you can read it cover to cover, but if you're like, there's a chapter like how to fire an executive or how to demote a loyal friend. It's like when you get in that situation, it's a good one just to read the parts that you're going through.
Definitely. It's on my desk. This is like, I go check it from time to time. And the final question, how exactly do you regain energy and motivation during hard times?
I think taking some time off is really good. It's hard to do, especially when you're going through hard times, because you want to problem solve and you want to, go down on, sort of double down on the problem. But like that exercise, a good routine, like that's a thing that I think I didn't take good care of myself in the early days because all I did was work. But since then, I've sort of been more disciplined with like daily exercise and meditation, diet, water, all the good stuff. Take care of yourself physically, mentally, emotionally.
Nice. Love it. Well, Kyle, it was a pleasure talking to you. Where can our listener follow you and follow your journey?
They can check me out. Really proposify.com, proposify.com if they want to check out the product. And then I'm fairly active on LinkedIn, Kyle Racki, Racki, if people want to reach out.
Awesome. We'll put all the links in the comments. Thanks a lot, Kyle. Have an amazing day.
Thank you. You too.
Thank you for listening to the Bootstrap Stories, the only podcast where bootstrap entrepreneurs share their journey in all transparency. If you enjoyed this episode, don't hesitate to leave us a review. And in case you want to see the interview, all episodes are live on the Guillaume Moubesh YouTube channel. Check out the link in the description and hit subscribe if you haven't already. Have an amazing day and make sure to also join us in our amazing Bootstrap community where we all helped each other to become successful and grow a profitable business. Take care and talk to you soon.